Well, I'm Andy Thompson, the Senior Editor, Private Debt Investor. Dan, would you like to briefly introduce yourself?
Sure. Dan Zwirn, CEO and CIO of Arena Investors, a $1.1 billion alternative asset and credit investor.
And you've been working on a white paper with a couple of academics from Johns Hopkins.
Yep.
And I think that was kind of fleshing out really some of the concerns that you had about the market.
Yes.
And looking to back that up with data.
Mm-hmm.
There's a number of areas you've identified which could present a problem. One of the areas we've focused on a lot is mid-market direct lending. That's been a very popular area for
Sure.
investors, as you know.
Yeah.
A lot of competition there.
Yeah.
And arguably, we've seen pricing go up to a pretty high level.
Yes.
Could you share some of your observations around that in terms of the research you've done on the mid-market?
Sure. Well, from a bottoms-up perspective, I built one of the early and larger businesses doing that in the United States, and there we were levering companies. Well, first of all, we really did that off the back of an observation that regular way banks and asset-based lenders weren't really looking to the quality of enterprises, really just accounts receivable, inventory, and machinery. So there were opportunities where we could lend at 3.5 times cash flow and charge 14 to 17% in 3-year pieces of paper with 2-year duration. That market is now 5 to 6.5 times cash flow, much weaker structures, much less security. Lending for 60% of the compensation. It's just really been priced to death, and that's further been allowed or propagated or incentivized by the prices people are paying for corporate assets, right? And so if I'm a lender, and it might make me feel good to have lots of equity, cash equity beneath me, independent of the fact that that cash equity may be paying a price for the asset that's far too high. And as an asset owner, the fact that someone's willing to lend me way more money than I otherwise should think I should get at way cheaper of a price might allow me to think, well, geez, I'm paying a lot, but my financing's so cheap that maybe it'll kind of work.
Yeah.
So those two together prop each other up and really encourage an explosion of activity in that area.
And we cover leveraged loans and CLOs as well. These are also kind of pressure areas. Your argument being that in leveraged loans, the quality of the paper just isn't there. And in CLOs, you were telling me that it's kind of being used as almost like an information or a transparency play because of the opaqueness of leveraged loans.
Yeah, look, as someone who's transacted in leveraged loans over the last 20 years, there were times where if you were interested in a name, you could call up a dealer and just say, give me all the information that's available and I'll make a judgment for myself and maybe there's something to buy. Now it's really much more closed. So unless you're already invested in the name, it's hard to get information on the name. And so if you're really trying to optimize, you might say, well, how do I get the most information while exposing my capital the least? Yeah. Well, that might be to start a huge levered CLO management company where other people will take up all parts of the stack so I can buy lots and lots of loans and accumulate lots and lots of data. Even though I have billions of AUM otherwise that could buy those loans, why use my money for when they're at par when I can get all the information when they're par and use my money when they're at 50?
Yeah. Yeah.
Not that we are doing that, but it's there's a notion that certain market participants might be.